Well, it's been a rough and a tough start to 2016 and markets have been hit by the OCD syndrome. Oil, China and debt. Things have been volatile and Indian markets are in a disarray. So what is the right way to invest in this kind of a market? Will the going get tough, or this is a good time to pick up some bargains if you're a genuine long-term investor? So to understand the India positioning, talk about long-term bets and also talk about some key trends which could differentiate India from other markets in 2015. I have the perfect guest, someone who needs no introduction whatsoever. He heads and runs one of the biggest foreign brokerage and local brokerage in India. Mahesh Nandurkar of CLSA. Mahesh, fantastic to have you back. Thank you for joining us.
Thank you very much, Nikunj. It's good to be back here.
It's been a crazy year.
Absolutely. It's just 20 days or 25 days and it looks like almost a year has passed. So much has happened. Markets are down almost like 10%, close to that. So yeah, it's been a very, very rocky start to the year, I must say.
Were you expecting such a rocky start?
No, see, the thing is, the trend has been on the negative side for a while, especially starting, last year, August, when we saw the Chinese devaluation. Then later in December, the US Fed hiked the rate. So there was some expectation that there's going to be some volatility. But I must admit that we did not expect, and I would doubt anybody would have expected this kind of a correction in the global markets and also the Indian markets.
Some global speakers are calling about a repeat of 2008. What is your house view? Can you feel or smell similarities between 2008 and 2016?
It definitely feels like that, given where the speed with which the markets have corrected in the month of January. But I think the setting is quite different, in my view. So while it is natural for the investors to be anxious and to start drawing parallels, but I believe that we aren't really in the situation that we were back in 2008. I mean, if you look at the global economy today, there are clearly two issues which are kind of rattling the global investors. One is the increase in the interest rates by the Fed, which is point number one. And point number two is the Chinese currency devaluation, and therefore the risk that it could export deflation to the rest of the world. I think this setup is very different from how it was back in 2008-9. So our house view is still that China would be able to manage the soft landing. I feel that while there is expectations that 100 basis point kind of rate hike will be done by the US Fed over the next 1 year or so, but ultimately it might not really happen. So we might see another rate hike or maybe two, but nowhere near what the market expects today. So my sense is that at least on the US Fed side, you might see some respite, although the China factors is something not very easy to interpret at this point in time.
Do you think we should not look at Chinese stock markets and consider that as the indicator, because there's a distinct shift in Chinese stock markets and the Chinese economy? Chinese stock markets was all about speculation and an artificial propping.
Yeah, so China itself has two parts, right? When you look at the stock markets, you have this China A shares or B shares, and then you have these H shares or the Hong Kong listed shares. I understand what you mean, that the China A share was very, very volatile and up 50% in 6 months and then down almost equal number. But however we may wish, the global investors will still look at China very, very closely.
So Chinese economy and Chinese stock markets?
Both. So if you look at a typical emerging market investor, then for him the Chinese markets is about 25% of the benchmark. India is about 7.5%. So we might ignore or pay attention, but the global investors have to pay attention to what China is doing or the economy is doing. And the sort of the views of the global investors will about the emerging markets in general will also in a way will be shaped by what happens in China. So I don't think we can ignore China. No.
Where does India fit in? On paper, I can prove that whatever is happening in the world is actually great news for our fiscal deficit. It is great news for our macro. We've never had oil prices on our side in last 10 years. Oil prices are on our side, yet we are getting hit hard.
Yeah, oil prices are clearly are on our side, and this is, I think, one of the I would say like a sort of a godsend boon without which I would even shudder to think where would our economy be, because with the oil prices falling from $100 or more than that down to about 30, it's about a $70 billion, because India imports on a net basis 1 billion barrels of oil every year. So about $70 billion of benefit, 3.5% of GDP. So everything else remaining the same, India's GDP should have increased by 3.5%, because we are not importing that much oil anymore. But we are just able to manage the growth rate that we had seen in the past.
So what's got wrong in calculations?
So clearly what has gone wrong is the fact that while all of us really celebrated the fact that inflation has come down in India, the CPI fell from 10% down to 5%, lowering of inflation has its own negative impact on the demand. And so we sort of being the investors, we look at the corporate earnings growth all in nominal terms, and clearly what we are struggling today is that the lower commodity prices have benefited our corporate margins, but the revenues have been hit very hard, and therefore on an overall basis the corporate earnings growth is just about in low single digits at this point in time. So there is a downside of low inflation, and we are in the transition period at this point in time. We haven't really adjusted to a lower level of inflation. I think now we are getting into a phase where forming a nice base of around 5% kind of an inflation number, and from here on the YOY comparisons should look much better. So in the nominal GDP terms, 2 years ago we were growing at 13-14%. Now it's down to 6-7%. And I think from here on, the nominal GDP numbers should improve. The corporate revenues and profitability should improve even more. And on a YOY basis, I think there are good times ahead for Indian corporate sector in general.
So when you talk to your global clients, are they selling because they have a compulsion to sell, or they're generally worried about India's premium valuation in an environment where global growth is depressed?
Yeah, so if you look at the correction in the Indian market in 2016 so far, while it has been very rapid, it is actually very much in line with what we have seen elsewhere in the world. Not just in emerging markets, even the developed markets have also corrected, by as much. So it is sort of pretty much a case of investors trying becoming more concerned about the asset class in general, equities as an asset class in general, keeping in mind the rising interest rates. I mean, remember that for the last 7-8 years we've had a very, very easy monetary policies all over the world, right? And now US seems to be kind of moving away from that. So the reason why the global investors are selling India as how they are selling the rest of the equities is also more because of this problem of the concerns on the rising sort of interest rate globally.
So the world is adjusting and India is getting hit because of that global volatility or global asset adjustment.
Absolutely. I would say that locally, at the India level, things are maybe slightly improving. You can actually see a path for improvement going forward. But the markets are clearly getting impacted by what's happening globally.
So right now, do you think the selling what we have reported or observed is largely sentimental? I mean, markets in the short term is about sentiment, medium term is liquidity. Unfortunately, liquidity is against us and sentiment is completely against us.
Right.
So is it sentiment and liquidity which is responsible for sell-off in India?
Mostly, I would say so, mostly.
So when will market recognize that India is a special situation stock and it does not deserve to get beaten down like other peer markets?
Yeah, so the thing is, if you look at it from the global investors' point of view, most of the investors tend to sort of bunch emerging market as a class. So as I mentioned, in emerging market, China has such a big weight, and India has about 7.5% weight, and there are like many other countries like Brazil and Russia and Indonesia, Southeast Asia, and so on. And a lot of investors take a call on developed market versus emerging market, at a very broad level, that whether you want to put money in emerging markets to start with. So my sense is that India or Indian markets will sort of be forced into this global game for some time. I don't think we are going to get decoupled anytime
we are down 10% broadly this year.
Right.
12-13% in dollar terms, slightly more.
Right.
Another 10% from here is that realistic, or that is something which you don't fathom at this point in time?
See, at this point in time, I think it's looking. I mean, I would give it a low probability. Markets going down by another 10% looks like a very low probability event, at this point in time.
So for that to happen, something has to blow up.
I think for that to happen, you need to see, what the kind of events. I think that could probably lead to such, big, drop is, further rate hikes in the U.S. You see, a big attack on the Chinese currency, and the currency depreciates by another 10% or so. I think those are the kind of events which are not zero probability events, but I think a very low probability event, definitely.
So what is your India positioning? If I scan through your latest research reports, the communication is that users decline to buy. But buy what? Buy economy related stocks, buy global denominated stocks. So what should be the anchor of the portfolio?
So what we've been advising investors is that while the Indian economy is showing some very initial signs of improvement, the corporate earnings growth will be much better in FY17, FY18 as compared to say FY14, 15, 16. So the last 3 years, the average corporate earnings growth has been about 4 to 5%. We expect the next 2 years that number to be about 15% or so. So a much better year in terms of corporate earnings growth. But yet the expectations on certain sectors and certain stocks are still elevated. So we are still not completely out of the earnings downgrade cycle. So if you'll ask me, which is that one theme that we are sort of looking at, at this point in time to sort of select stocks and sectors, that's clearly earnings visibility. We are basically looking at stocks which can deliver 15% plus earnings growth with high level of confidence. That's one, and where the valuations are not really out of the whack.
How to find such things? Now, where earnings is strong and valuations are also on your side. This is a near perfect market.
No, it's actually not. I mean, there are still enough stocks and enough sectors, in this market, which actually offers you, this combination. And I would say, the sectors that sort of fit this bill is private sector banks, where I think a 15 to 20% earnings growth is very likely. Valuations are not that high. I mean, if you look at it even from a price to book multiple basis, most of the banks seem to be trading in line with the historical averages. If you look at last 10-year averages, so on an absolute basis it might look like an expensive stock, but this is how it has been for the last 10 years. I mean, the last 10 years include ups and downs. And that's because the high quality of the management, the high ROEs and so on. Also, it's always fashionable to look at banks, in terms of price to book. But if you just set that aside for a moment and look at these stocks, from the price to earnings multiple basis, it's not expensive. It's actually not. So private banks therefore look quite attractive to us. IT sector, IT services. Yeah, large cap IT, there are certain mid caps as well, where we believe that a 10% dollar revenue growth is very likely, and if you build in 5-6% of annual currency depreciation, you're talking about a 15% revenue growth. And ideally, when the currency depreciates, you usually tend to get some margin improvement as well. But even if you take an assumption that there is no margin improvement, you are still getting a 15% plus earnings growth. And once again, valuations are not really crazy.
But for a sector where growth is contracting, I mean, gone are the days of 30% growth. Now we are looking at growth in late teens or early teens.
Right.
Yes, P multiples are also in the teens.
Right.
But some of the commentary from most of the IT companies is that digitization is a challenge, and in the short term we should not expect anything dramatic. So are you bullish on IT just because it's a safe haven?
See, the thing is, digitization is a challenge, but as well as an opportunity as well. There are a few, IT companies which have actually, done pretty well on, what is called as SMAC, social, mobility, analytics, and cloud. So this is really the digital platform.
So you like companies which have a presence in SMAC?
Right, because that is, where the growth is coming from. It's also a slightly higher margin business. So that is something that we like, and also at the same time, we believe that IT sector might actually also benefit from operating leverage. And what I mean by that is, over the last few years, we've seen the wage growth in IT sector, and as is the case with the other sectors as well, it's been close to double digits. But now the CPI inflation in India has come down from 10% levels down to close to 5% now for the last 2 years nearly. And the wage inflation hasn't really come down as yet. And my sense is that the wage inflation might come down going forward because the inflation levels have come down. And I think IT sector could be a beneficiary of that. So, whether I am willing to pay a 16, 17, 18 times P multiple for a similar earnings growth, which is what IT sector offers today, I very much am.
You know, 3 years ago, if I would have asked you to talk about a sector where growth visibility was decent, it would have been consumer staples. Names like HUL or perhaps Colgate. That sector is now looking slightly dodgy. Volume growth is not there. Now, whether it is Patanjali or Ayurved, the dynamics are changing right now.
Right.
What's your view on consumer staples?
So, consumer staples is, I think, getting impacted because of two factors. So, one is, we have a much lower nominal GDP growth as we as we talked about. So that is hurting.
So pricing power is missing.
Pricing power is missing. As you mentioned, the volume growth is weak as well. And I don't really see a big revival in rural spending, in the immediate future. And over the last sort of a decade or so, the staple sector has benefited big time. From the booming rural consumption.
Commodity prices have also come down, let's be realistic. Soya, copper, soya, cotton, everything is down.
Absolutely. So, as a combination of these two, I don't really see, how, such a high valuation, sector, can continue to deliver returns year after year.
So, the problem in pharmaceutical is very unique. It's largely regulatory and it is hitting the entire sector per se now. What is your understanding of the problem? Is this a structural problem or this is a cyclical problem? One company may get hit in this quarter, another company may get hit in next quarter, but eventually these companies will come out. What is your understanding when you talk to these companies? Are they nervous or they can fix this problem?
No, this problem has definitely a relatively new problem which has arisen, say, in the last 18 to 24 months. We've clearly seen that the incidence of US FDA related issues like warning letter or import alert and so on, have increased dramatically over the last 2 years, which has clearly increased the sector beta, and so to that extent it has driven some sort of a derating. Also, we have to keep in mind that the US opportunity, especially the first to file opportunity, is going to be shrinking as we go ahead. So we have to adjust to the fact that the long-term earnings growth, let's say the next 5-year earnings growth is not going to be the same as the previous 5 years earnings growth. So there is clearly an earnings growth deceleration. But having said that, within the sector, we clearly see some opportunities, especially the ones where we have seen the stock getting impacted because of variety of stock specific reasons or the US FDA related reasons. And we believe that in FY17, of the low base which has been created in FY15-16, we believe that pharmaceutical sector will be among the fastest earnings growth sector under our coverage universe.
The other bright story for the pharmaceutical sector is that the new Gudifer guidelines. They will ensure that US FDA will go very easy on giving new approvals. So a year ago everybody was celebrating pharma stocks as if they were must-have of the portfolio. Right now they are down, lying at the bottom of the barrel. So fear and greed again. A year ago it was greed, now it is fear.
Possibly. Is one way of looking at it. But as I said, some of these observations made by the US FDA will probably be having a negative impact on the earnings for the next couple of years.
Okay. So the observations are critical, but they're solvable. I mean, I'm looking for that answer. Can Indian pharma companies get over this hump?
Yeah, it looks like suddenly so we or the sector had a pretty smooth ride, right up till say a couple of years ago, and suddenly we got into this relatively new problem, which the companies were anyway kind of dealing with earlier. It's not that US FDA never visited Indian plants in the last 10 years, but it's a relatively
This is not election rhetoric. 2016 US presidential elections.
Well, yeah, so around the US election time, there are always these exporting sectors become a question mark, whether it is pharma, whether it is IT, In fact, there is enough rhetoric, around the IT sector as well. But we have done this analysis over the last, 4 or 5 US election cycles. And what we've seen is that this election rhetoric is nothing new. It happens all the time, but it seldom impacts the business. Even the stocks do not necessarily underperform during an election year. So we still continue to be quite positive on the IT sector in general and select names in pharma.
One big hurrah for Indian economy is that government now has some surplus to spend. Government spending is visible in roads, railways, defense, construction companies would benefit. So how should one align with this, with government spending? I mean, if you see so much of government spending is coming, the multiplier effect would be visible. And as smart investors, you would have already identified themes, areas or pockets which will gain because of this.
No, certainly, I think roads, is a sector where the improvement is already visible. We've already seen, the rate at which the new road projects are being awarded has already jumped to almost like 20 kilometers a day or something. And the target is to take it up to like 30. And, our talks with the companies tells you that, there is indeed, an improvement, on that side. So roads is clearly one way of playing that. Railways, is also gaining traction. And I think over the next couple of years, we'll see substantial improvement on the railways infrastructure. We're quite excited about the power. I think this whole new project, or this whole new scheme called Uday, to sort of take care of the problems of the state distribution companies. It has off to a very good start. Obviously, a lot more needs to be done, but I think it is off to a good start, and that is throwing up options in the power side. And I think finally, even the urban infrastructure, that also seems to be, quite a bit of a focus area. Now we are seeing it's not just the central government, but even the various state governments are pitching in with their own funds and their own commitments and so on. So I think these are the 4 areas: roads, railways, power, and and the urban infrastructure. But within power, I must say that I'm not that bullish on generation side. Because we have sort of enough capacities which are currently operating at 60%, 65% utilization rates. There are enough new capacities being built, especially on the thermal side. So within power, I will be more excited about the transmission side and on the distribution side, not so much the generation side.
So if I summarize today's interaction, you are of the view that don't write off the India story. I mean, this is not a bear market. We are in a strong bull market, and what we are witnessing right now is more like a very sharp, a sizable and a very nasty bull market correction.
Yeah, so what I would say is, for any long-term investor, with a 3-year to 5-year kind of an horizon, I think the current sort of correction offers definitely, a very good buying opportunity. But, one must keep in mind that it's not going to be a V-shaped recovery. So like similar to, what we saw, let's say in 2009 or 2010, when after a big fall, the markets kind of took off in a very, very meaningful way. I think that kind of a situation is unlikely to happen. And we are probably in the initial phases, I must say, initial phases of, global equity risk aversion. So we might sort of, move around these levels a little bit here and there, say maybe for the next 6 months or so. One should not be expecting a big bounce, but yes, definitely a very good opportunity to start accumulating stocks, good quality names over the, let's say, next 6-month period, for one to sort of hold for the next 3 to 5 years. So
where do you think 2016 will close? I mean, we've already gone down by 10%. Can we, in this course of 12 months or 14, 15 months, can we regain whatever we've lost and gain much more?
Yeah, so as I said, it is more to do with global factors, as we
assuming that globally things are stable.
So assuming globally things are stable, I don't see any reason why we should not be able to recoup.
And should we be worried about FI activity? I mean, are they sitting with a lot of cash and stocks which they want to dump?
I think on the FI side, one segment of investors, where one needs to be a little bit cautious about, in terms of the potential risk on the downside of selling is, the oil money or the sovereign wealth funds. Our analysis suggests that they currently hold about $25 to $30 billion.
That's a lot of stock.
That's a lot of stock that they own. Not all of that is oil money, by the way, but a large part of that is. And we haven't really seen any selling from whatever data that we have so far.
So should I be happy over it that we've not seen any selling?
Well, it's a difficult question because on one hand, some of these oil-based investors might also be thinking that India is probably one of the hedges, one of the few countries globally that benefits from a lower oil. So let me keep my money there as a hedge. On the other hand, if there are, the domestic pressures to, sort of bridge the fiscal deficit, our government sort of spending and so on. So it's a difficult game to predict, but, that is one segment of investors which, I think, can move the needle.
Next time when we meet, we would be interacting on a slightly more optimistic note. Appreciate your time.
I certainly hope so. Thank you very much. Thanks a lot.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off, and as we wrap up the show, the sun is about to set. And the verdict on this edition of Market Makers is that sun is not setting when it comes to Indian economy. This could be the darkest just before the dawn.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.